let's unpack the Fed, because that was kind of a mess, really. Because I thought that the overall meeting was hawkish, but I thought that Powell was trying to be dovish, and in a way that he wanted to justify going ahead with the cut, even though more recent data suggests that they probably shouldn't, or if they didn't look so far back at the NFP revisions as well. For example, if we discounted that, they wouldn't have been cutting today. But he's clearly placing a lot of importance on that. So to sum up what he's been saying here, employment risks have risen, downside risks, mostly from immigration. There's a clear sign of slowing in demand, and yeah, that's their view that the labor market is weakening. And here he's saying that he doesn't want it to soften anymore. Don't want it to. Very, very telling of what his stance is, and as well as saying that he can no longer say the labor market is solid. Inflation, somewhat elevated. He's saying that the effects of tariffs on inflation remains to be seen, though the increase in good prices did account for most of the inflation. If the effects of tariffs are going to be seen somewhere, it's going to be in good prices, isn't it? So, and then I expect tariff-driven price increases to be a one-off, basically transitory. We love that word. And it's going to be short-lived. Case for there being persistent inflation outbreak are less and less than they were in April. So clearly, he's not seeing as much risk to inflation, given that initial liberation day tariffs are being pulled back. On growth, has been slowing, but that's already old news. Default rates have been ticking up, and apparently, they do watch that. The economy is fine, acknowledging that and gratifying that the economic activity is holding up. So probably in reference to something like retail sales, for example, a good bit like consumption, probably that, and households are still in good shape. Policy, equality, neutral, moving closer to neutral, because policy had been skewed towards inflation, and it's time to acknowledge the risk to the employment mandate. So nothing we didn't already know. Their policy stance is moving towards the employment mandate, and he's saying that it's a risk management cut. And I think this is a good point, right? That if we do start to see layoffs, then that could turn into something quite bad very, very quickly. And that looks like the main reason why they voted to cut to a more balanced one. And it's all about these words, right? Heading towards neutral. And if neutral is somewhere closer to 3%, they do want to be a little bit closer if they do see these risks. Overall, Powell's tone did seem quite dovish. However, the dots, a lot of this is quite hawkish. We had one voting to hold. I'm going to go out on a limb and say that was Lisa Cook. She has more reason to oppose Trump and project Fed independence than anybody else. I thought one or two even joining her in that camp, just to stick it to Trump, don't fuck with our jobs kind of thing. And then you have Stephen Moran down at the bottom, voting for 50 basis points of cuts and 3 consecutive 50 basis points of cuts. Not extreme at all. Jeez. So in the end, you had one voting to hold rates, and even holding rates till the end of the year. And then you have 6 who voted for a cut and wants no more cuts, because that's the band we're in now, the 4 to the 4.25. And then you have 2 wanting one more cut, and then 9 wanting 2 more cuts. Now, I did a weighted average by excluding this guy, and it's at 3.99%. So that's the upper bound, right? So it's 4% upper bound and 3.75. That would put us here. So the Fed, the committee, is still leaning towards one more cut by year end. So I thought the dots were hawkish, even though the median was 50, and the initial reaction to that was, yields just plummeting. But it did recover later on. And I just wonder whether, things are being pared back because there is that, there's still some discrepancy between market pricing and what dots are saying. And then we're seeing, not much has changed, but there has, you can see that it was fairly even. We had a downshift of 25 basis points from here to here. It was more even, but now it's a little bit more lopsided towards the bottom end. So slight skew towards 2, but the committee on average at 1 more. So this is the main reason why I thought the dots were hawkish, because the June projection projected fairly weak growth, right? 1.4 to 1.6, and it's been increased to 1.6 and 1.8. They expect stronger growth, and they also expect unemployment to be lower, even though Powell's been talking about how the labor market is weakening and downside risks have increased and so on. But that doesn't tell you that it is. Maybe it's because the Fed actually wants to get 2 cuts in by year end, and that would actually be enough to save the labor market. I don't know. But it's all very pro-growth, pro-economy type of projections. PCE inflation expected to be higher, core PCE as well. And then if we look at the central tendencies, which is basically your trim to mean, it's taking your extremes out, the highest and the lowest extremes of all the projections, and then you get the central tendency, and you can see that it's fairly strong. And then the Fed funds rate as well, 3.9 to 3.6. Which is, quite a dovish shift, but that's obviously due to Stephen Moran, or Myron, as people are now calling him, which I didn't know how to pronounce before. And if you take the midpoint of this, that gives you 3.85%, which is basically the midpoint of 3.75 and 4, around there. So the majority of the central tendency, again, is confirming that, the Fed, they are at 1 more cut for the remainder of the year. So stronger growth, lower unemployment, stronger inflation, and yet Powell's been saying all the things that he's been saying. And I think he's just trying to justify doing a rate cut today, that it was just a risk management cut. So Powell, dovish, but hawkish in the projections. So where does that leave us? That the current market pricing for the year end is 3.64%. And the effective Fed funds rate should now be 4.08, I think. So 4.33, 25 basis points. Yeah, 4.08. And if we price in 3.64, that's 44 basis points. So we're 44 basis points of cuts being priced in to get to this implied level. And market still expects two cuts. Now, the risk is obviously that NFP comes in weak, and then we start to price in the potential of a 50 basis point cut, or it comes in strong, and then that kind of pairs back towards sort of 30 basis points of cuts, where the second cut is more of a 50-50. I'm in that camp. I'm in that camp where, we will kind of price out some 15, 20 basis points of cuts, which would take us back to sort of, these sorts of levels here. So that's kind of where I am. Obviously, NFP, if it's weak, then that would change that all. In terms of the market reaction as well, we saw a little bit of bear steepening, longer 10-year yields. This is the 2-year, 5-year, and 10-year from left to right. And we saw a 9 basis point bounce in the 10-year compared to the 2-year, which only saw, about 7 or 8. So a slightly larger bounce in the longer end. And so that's a bear steepening. And bear steepening, if you think about our macro regimes indicator, that's usually reflective of stronger growth and inflation expectations, longer term growth and inflation expectations improving. So with Powell being quite dovish, we saw this big turnaround in rates. And I think we probably should have seen that right off, but we didn't, and we just saw these crash. And I think they were just taking the dot plots at face value with that Moran factor and everything else. But eventually, we did finish higher, and that just seemed to be the right reaction, and this one the wrong one. So I think this is going to be the reason why we also can expect the dollar to find support. There's some insurance against the growth concerns, and growth concerns has been the main theme in rates, where we've seen bull steepening and bull flattening type regimes because of that. And so now that we got this risk management cut, that's given growth and expectations a lift. I think the growth scare is off the table. The dollar should not, because, the dollar was also selling during those regimes too. So we could be seeing a shift here. And so far we are seeing a small shift. And so that's why I think we're going to see some support in the dollar. Stocks probably will find some support into OPEX, but beyond that, I'm not so convinced. I think they've enjoyed a lot of the same narratives that the dollar didn't enjoy, and I think we're going to see that flip.